Very good morning to all the distinguished dignitaries, delegates, professors, and my dear friends. Sifico has been organized by the Center of Excellence in Capital Market, along with the Department of Finance and Law of the Institute for over a decade. The conference is also supported by FinStreet, the finance committee of the KJ Somaiya Institute of Management. It is currently in its 11th edition, with this year's theme being Sustainability of Financial Institutions and Markets in Current Challenging Times.
The COVID-19 pandemic has caused an unprecedented human and financial crisis. Financial institutions all across the world are monitoring and dealing with the effects of the COVID-19 pandemic. They are working to understand the immediate challenges to capital markets, banking sectors, and economies. Sifico 2022 aims to address various issues and concerns related to the sustainability of financial institutions and markets in the current challenging times and have an insightful deliberation by the researchers.
We are delighted to have amongst us three luminaries from the industry, Dr. Dirk Baur, Dr. Muhammad Hamid Uddin, and Srimati Vijayalakshmi. Our director, Dr. Monica Khanna, and conference convener, Dr. Pankaj Trivedi. Good morning, ma'am and sirs.
A leader is one who inspires others to dream more, learn more, and become more. The director of our institute, Dr. Monica Khanna ma'am, is one such leader who empowers us and guides us towards excellence. I now request Monica ma'am to deliver the welcome speech.
A very warm welcome to all of you and a very good morning to all of you. I would first of all, I would like to congratulate the Department of Finance and Law for continuously organizing the Sifico conferences. And this Sifico 2022 is the 11th edition of the Finance Conference. So a very hearty congratulations to the entire team of the faculty and the students led by Dr. Pankaj Trivedi. The theme for Sifico 22 is Sustainability of Financial Institutions and Markets in Challenging Times. It is also my proud privilege today to talk about this topic and also to welcome luminaries in this area. I would like to welcome Dr. Muhammad Hamid Uddin from the University of Southampton in Malaysia, Dr. Dirk Baur, he is from the University of Western Australia, and Srimati Vijayalakshmi, she is the Chief General Manager, Head of Microcredit Innovation at NABARD in Mumbai. I am no expert in the field of finance, but I would like to put a few of my thoughts together and to inform them to you. The theme of the conference today is sustainability in financial markets, which is really very contemporary in the pandemic, the current pandemic environment. In fact, today morning itself, when I was reading the Economic Times and reading how the markets, the stock markets have really gone down, I think this really talks a lot about the underlying uncertainties in the financial markets and also in the stock markets. What began as a health crisis in March 2020 quickly extended into a business crisis. Hardly any business sector has been left untouched by the COVID-19 outbreak, whether it is the aviation sector, whether it is the tourism sector, whether it is the manufacturing, transport, banking, financial services, insurance sector, the retail sectors, and so on. In fact, we can see really paradigm changes that have happened in the performance of these sectors and the manner in which they are conducting their business. To steer the country through these unprecedented times and ensure sustainability of the markets, India's central bank, that is the Reserve Bank of India, and the Indian government implemented several measures, whether it is fiscal, legislative, and operational. The government of India began a series of initiatives. All non-essential services in the country were halted, and an aid package of more than USD 260 billion was made available with the aim of creating a self-reliant India. The financial services sector is enormously affected due to its correlation with the broader economy and its activities, and linked to all other sectors' activities, oscillating from financing to spending to savings. Like other industries, the financial institutions are facing a broad range of issues related to operations, employees, client servicing, stakeholder management, business efficiency, profitability, business resilience, and so on. Varieties of actions are being taken by financial institutions in India and globally to navigate through these challenges and to curtail the impact of the crisis while protecting business continuity and solvency. In order to ensure sustainability, the most important factor that comes to my mind is the preparation and rethinking of business models while looking for opportunities arising out of the crisis. Today's conference has attracted very good papers from India and abroad. There is a lot of discussion and debate that's going to happen today. The researchers presenting their research in this conference would have definitely thought about and discovered many such measures for ensuring sustainability in an uncertain environment. And during the course of the day, during the proceedings, I'm sure there's going to be a lot of light that's being thrown on these topics, and there is going to be a lot of learning for all of us, and it's going to really spark a lot of debate and a lot of thinking process amongst us. It is once again, I welcome all of you to the 11th Sifico 2022 conference, and I wish all of you a lot of learning and a lot of takeaways from this conference. And thank you so much for accepting the invitations and being here, taking out your time and sharing your thoughts with us. Thank you so much and welcome to all of you.
Thank you, ma'am, for your encouraging words. Time and again, Sifico has emerged as the platform to share knowledge about the multiple aspects of the financial world. So let's have a glimpse of the journey of Fin Street over the past few years.
Greetings everyone. Let me take you through the journey of one of the prominent committees in KJ Somaiya Institute of Management, Fin Street, the Finance Committee. The seed idea was to bridge the gap between industry and academic curriculum through effective delivery of knowledge-oriented sessions and events by a network of highly motivated members and renowned industry experts. The committee's history goes back all the way to the inception of the college, and currently it's flourishing under the guidance and leadership of Dr. Pankaj Trivedi. The committee has been expanding in scope, in its influence and activities year after year with new initiatives such as magazine and journals like Finlay, a monthly finance magazine covering sector analysis, company analysis, person in focus. It has one of the highest readerships amongst all the monthly magazines across B schools in India. It is currently running its 107th edition as of January 2022. The Fin Street Journal, a weekly newsletter helping readers stay updated with recent financial information and analysis on various parameters like macroeconomic indicators, corporate earnings, market overview. It is currently running its 108th edition as of January 2022. We also cater to finance enthusiasts by organizing events like Winzomania, an intra-college business quiz that tests participants' financial and business knowledge. Lock Stock Trade, an inter-college virtual trading competition with real-time stock quotes. Abhigrahan, a one-of-its-kind inter-college mergers and acquisition warfare, tests participants' valuation and negotiation skills. Equity Research Competition, an inter-college event wherein the participants need to come up with their analysis of a listed company. Investrix, a corporate panel discussion wherein stalwarts from the global finance industry come together on one platform. Sifico, International Finance Conference, where we not only hear from esteemed guests but also organize paper presentations on various contemporary financial themes. And today, we welcome each and every one of you to Sifico 2022, the 11th International Finance Conference organized by the Center of Excellence for Capital Markets in association with Department of Finance and Law of KJ Somaiya Institute of Management. The COVID-19 pandemic has caused an unprecedented disruption in the human and financial sectors. Financial institutions worldwide are monitoring, assessing, and dealing with the impact of the COVID-19 pandemic. They are working hard to understand the immediate challenges to capital markets, banking sectors, and global economies. Sifico 2022 aims to address various issues, challenges, and concerns related to the sustainability of financial institutions and the markets in current challenging times, and have an insightful deliberation by the researchers. We will be enlightened on the issue by a research paper presented by experienced researchers in the field of finance, as well as words of wisdom from three illustrious stalwarts from the industry: Dr. Dirk Baur, Dr. Muhammad Hamid Uddin, and Srimati Vijayalakshmi. Our director, Dr. Monica Khanna, and conference convener, Dr. Pankaj Trivedi. Let's hear from the experts themselves.
This video certainly took us to the memory lane of history and Sifico. Now, I invite Dr. Pankaj Trivedi, Dean, Faculty of Commerce and Business Studies, Area Chairperson of the Department of Finance and Law at KJ Somaiya Institute of Management, to revisit Sifico's Hall of Fame. Since the inception of Sifico in 2011, Dr. Trivedi sir has played a pivotal role in conceptualizing as well as ensuring that the brand grows internationally with each progressive year. I now request Dr. Pankaj Trivedi sir to speak on the journey of Sifico.
Good morning to all of you. Welcome to all of you. Dr. Dirk Baur, Dr. Hamiduddin, Madam Vijayalakshmi, our director, Madam Dr. Monica Khanna, all research delegates of the conference, the co-convener of the conference, Dr. Raghu Kumari, Dr. Kalpakkam, Miss Emma from Department of Finance, my faculty colleagues, members of the Fin Street, and my student friends. On behalf of KJ Somaiya Institute of Management, as well as on my personal behalf, a warm welcome to all of you. I also make a note of the presence and welcome our own Professor Thomas Berger from Germany. Sifico is an annual international finance conference. Currently, it is in 11th edition. It was started way back in 2011. It was a modest start by Center of Excellence in Capital Market, jointly with the Department of Finance and Law of KJ Somaiya Institute of Management. The objective of the conference is to disseminate the knowledge gained by the researcher on the topics relating to theme of the conference. Regarding theme of the conference, it is already said, the theme is sustainability of financial institution and market is the theme for the current conference. We invite research papers from academicians, researchers, industry practitioners. And also, we give opportunity to the students to present their paper into the conference, of course, along with the guidance of some faculty. So with this objective, this conference was started. And then the selected paper presented from the conference are also published in a reputed journal in due process. The another objective of the conference is to give platform to the researcher to present their ideas to present their research work in front of the experts. These experts are chairing the session. They listen to their research work and they give valuable inputs. Not only that, they can also have discussion with their peers, deliberation related to that work, and in the process, they are able to come out with good research writing. So with these two objectives, this conference was started. The current conference was planned in the month of June 21. This was the time when our country was in the process of vaccination. In fact, entire world was in the process of vaccination. And there was a lot of uncertainty with respect to normalization of business and economic activities. The impact of 2020 on financial institutions and market were so serious that its sustainability issue emerged as a debate. Due to rising cases of Delta and Omicron in 2021, the market sentiment impacted the expectations of domestic growth and inflation. As Madam Monica has also talked in her speech, the Reserve Bank of India, in spite of taking accommodative stance and keeping the interest rate lower, the recovery in the Indian economy is uneven, even now. Consumption expenditure, private investment expenditure are continuously low, and unemployment level is showing higher and higher. The second and the third wave has really completely upset all the calculations of policymakers and institutions. If you talk at global level, even at global level, you are noticing the same thing. In fiscal 2021, World Bank drew its AAA rating on a strong standing in the market. World Bank has raised $68 billion in sustainable development bond. Why this is raised? To support the development activities, including COVID-19, and to build the resilience of the future shocks at world economic level. So friends, in this kind of environment, the papers that we have got, they are from various fields. They are from various ideas. We have received total 23 papers, out of which after double-blind review, 14 papers were selected for presentation. You will find a variety of issues which are covered by the researcher in this conference, like financial investment, corporate finance, debt market, insurance sector, rural credit market, sustainability practices by the corporate, risk management, fintech, etc., etc. So I'm sure that at the end of the day, there will be good learning based on the deliberation that will take place and the inputs that we will get from the experts that we have invited. So once again, thank you very much, all of you, for your time. And I wish a great success for this conference. Thank you very much.
Thank you, sir, for walking us through the illuminating journey of Sifico and enlightening us with your words. Holding on to the same spirit and curiosity, without any further ado, let's welcome Honorable Chief Guest for our event, Dr. Dirk Baur. Dr. Dirk Baur currently serves as the Professor of Accounting and Finance at UWA Business School, University of Western Australia. He holds a master's degree in economics and received his PhD in financial econometrics from University of Tübingen in 2003. He has worked for the Joint Research Centre of the European Commission and was a postdoctoral fellow at Trinity College Dublin and a lecturer at Dublin City University. He has also worked as an Associate Professor of Finance at University of Technology, Sydney, and Kihin Logistics University in Hamburg. His specialization is in the field of financial economics and financial econometrics. He's an expert on the financial economics of gold, the modeling and estimation of financial contagion, dependence modeling, and empirical application of quantile regression. His current research projects are on shadow banking, Bitcoin, asymmetric volatility, and gold. His work has been published in journals like Journal of Empirical Finance and Journal of Banking and Finance. He has 7,994 citations under his name until today. He currently serves on the editorial board of Finance Research Letters, the Journal of International Financial Markets, Institutions and Money, the Research in International Business and Finance, and the International Review of Financial Analysis. Thank you for greeting us with your presence today, sir. I would now like to invite Dr. Dirk Baur for the keynote address.
Thank you very much for the kind introduction and for the opportunity to speak today to you. It's a great honor, and I hope after my presentation you will feel that you learned something, that it was worth it. Okay, so you can see my slides, is that correct? Good.
Yes, sir, we can.
Perfect. So I will start. The title is linked to the topic of the conference, of course. Quick outline, I give you a brief background of what I think is important in the COVID-19 context. Very simple graphs initially, and then I go into the ESG and sustainability issue. And then I will talk for about 10 to 15 minutes, as it was asked to, about research strategies for researchers or PhD students. All right, so let's start with going back in time a little bit. When we look at the MSCI World Index, we see that it drops here. Let me quickly get the this pen thing. No, okay, but so you see the drop, and after that, since that drop in mid-March 2020, stock markets have gone up, and as we've all noticed over the last couple of days, they are coming down. But I would think that it's more due to expected rises in interest rates that stock markets are under pressure now, rather than the Omicron variant or other effects directly linked to COVID-19. Of course, higher inflation expectations are somehow related to supply chain disruptions caused by COVID. So is this this drop here in March 2020 just a stock market phenomenon, or can we also see this in other markets? And when we look at, for example, government bond markets, so here 10-year indices, we see when you look here at the beginning of the graph, again mid-March 2020, they all fell. So it was not only stock markets, but also bond prices fell. All right, so there was a sell-off in stocks, there was a sell-off in bonds, and since then it's less clear what happened since then compared to the stock market. But we see also that drop here. So the other market that is of interest is commodity markets. So gold is, as far as I know, and you all know, is a big topic in India. So the gold price here in blue, not a small dip, but relatively stable, right, compared to what you've just seen for the stock market or the bond market. And then something that I left here on the graph is the Baltic Exchange Dry Index, which is essentially an index for the shipping cost. How much does it cost to ship goods from A to B? And here you see a clear upward trend, which is not as good as a rising stock market, because that shows that there's, of course, things become more expensive to ship, and that has potentially a big effect on inflation expectations, and then expectations about rising interest rates, and then that's in turn bad for the stock market. So if we zoom in, if I get rid of the Baltic Dry Index and look at it, so we see the drop in mid-March, right? Like also commodity markets dropped, gold also dropped a little bit, but not as much as the other three, oil and the commodity indices, like the S&P Commodity Total Return Index and the Bloomberg Commodity Total Return Index. And as you've all You're all aware of also the fact that the oil price went briefly negative in late April, I think, 2020. So commodity markets were also affected by the COVID initial outbreak. And then the last thing we look at here is, as a background, is cryptos. What you see here, the blue line is Ethereum and the black line is Bitcoin. So they're both normalized to 100. And also there, mid-March, we see a clear drop, which is quite important because before COVID hit, there was a lot of talk that Bitcoin is the new gold and that Bitcoin is a safe haven, that it protects investors from shocks, from severe shocks, from crises. And when you look at this here, how the price dropped from 130, when we go back to, let's say, mid-February to mid-March, it's a big drop, more than 50%. And that is not consistent with a safe haven, which also shows that, because I've said that before COVID hit, there was no, since the inception or the creation, invention of Bitcoin, there was no big shock, right? It was created after the global financial crisis. So it was always, quite a stretch or maybe a little risky to say that it's a safe haven. And here we see, again, that similar to all the other asset classes that I've shown you, also here they clearly dropped in mid-March. So digging a little bit deeper into these issues, I briefly go over two papers that I'm working on. One is about gold and gold shares, which shows some interesting difference. The idea here is that gold shares are linked to gold, and if gold shares deviate from the gold price, the fundamental, gold shares are influenced by other factors such as sentiment and uncertainty, and that tells us something about these non-fundamental effects. And it's very clear, very strong what we see there when I show you that in a minute. And the other paper is about gold and exchange rates, and one big message here is that essentially it's a relative thing. So when you look at gold in US dollars, that's not too interesting for a lot of people on this planet. People in India, for example, would look at gold in local currency. They're, I guess, less interested in gold in US dollars. And so when we just focus on gold in US dollars, the message, the insights can be sometimes a bit misleading. And I'll show you that as well shortly. So that's the first paper and the abstract. Hard to read. So just focus on this one here. I want to focus on a decoupling of gold companies from the price of gold, and that illustrates that gold shares are exposed to market risk and not a safe haven. So they're different to gold, and it also shows this, what I think the big thing, the difference to fundamentals. So here, this, what is it, blue turquoise line is gold in US dollars. I'll show you later that it's very different in other currencies. And then there are gold shares, three different ones: gold explorers, very risky; gold developers, also risky but less risky than the explorers. That's the red line. And then gold producers, those that produce gold, as the name suggests. That's bluish, dotted and dashed. And then there's the Australian stock market index, the ASX 200, which is, it's an Australian perspective, but doesn't really matter because all stock markets, as you've seen earlier, they fell in mid-March. So that wouldn't be very different if I presented or had included other stock markets here. So the big thing is that there's a decoupling, right? Because these gold shares, they usually move with the price of gold. But then here in the crisis, you can see that they decouple from the price of gold. And now you could say, well, one big question is that due to fundamentals? Have fundamentals really changed for gold producers? Or is it other stuff, sentiment, uncertainty, things that affect investors, but in this case are not too closely linked to the fundamental, which is gold for a gold producer. And we see this decoupling, so they deviate from the gold price clearly, but then they also come back. And if we extended that window, you would see that they come back to the price of gold. So that's it. And the other paper that I want to briefly summarize is this one: is gold a safe haven in all currencies? And one key thing is that volatile and risk on currencies boost gold's safe haven property, while risk off currencies weaken the safe haven effect. So the background here is exchange rates play an important role for the safe haven property. A simple example, hopefully, is if a currency depreciates against the US dollar, and usually the Australian dollar does that quite strongly, but most currencies depreciate against the US dollars in crisis. Over the last couple of crises, the price of gold in that currency increases relative to the price of gold in US dollars, which is good for local investors. And something I can add here, if both gold and the US dollar are safe havens, which some people claim, or there's some evidence that this is the case, and if they both then increase in crisis times, then it's possible that the price of gold in US dollars does not increase or even falls, but it increases in all other currencies, which is a good thing, and exactly what you would expect from gold as a safe haven. Can be expressed in with this formula here. If this could be the change in the price of gold in Indian currency, for example, and then this is 1 plus the change in the price of gold in USD times 1 plus the change in the value of the Indian currency relative to the USD. And so if we need more Indian currency here to buy USD, that means that the Indian currency depreciates, and that has then a positive effect on the price of gold in local currency, which is exactly what most people would hope to get from gold in their local currency, right? So the US dollar would like, do Australian investors care about the gold price in US dollars? Well, if they live here, not really, and that would be the same for investors in India. So I can skip the Australian one. So here the Indian one. So the solid line is the stock market, and you can see that, not surprisingly, mid-March, stock market in India fell, as pretty much all markets did. And then we have the orange line is the gold price in US dollars, and the yellow line is the gold price in local currency, in Indian local currency. And you see here that because the yellow line is above the orange line, that the gold price in local currency in India went up by more than the USD. And that is true for a lot of currencies, but also here applies to India, which is a good thing, right? Because here the depreciation of the Indian currency relative to the USD may not be a good thing for all sectors and everyone, but here for the price of gold and for those people who hold gold, it's a good thing. We can also see, just move here my, if we rank the correlations of the stock market local currency with gold and local currency, we see here that India is, so I do this for 68 countries or markets, India has a negative correlation, which is exactly what you want, right? When the stock market falls, gold goes up in local currency. That doesn't happen in all currencies, as you can see up there. Some or markets, some up here, Venezuela because of the high inflation rate, but also Argentina, Hong Kong, Jordan, China, and so on. They have a positive correlation, which then means that gold doesn't really do exactly what you would hope that it does, that it protects investors from losses. And here, if we just look at the performance of gold during crisis in local currency in relative to the US dollar denomination, we also see here that in India, local currency, GFC, global financial crisis 2008, gold price went up in local currency by 10%, and it went up by 20% during the COVID outbreak. And when you look at the US, which is 2 countries below that, there's like some in between, but I cut them. There, the gold price fell during the GFC, right? But that's just in USD. And it is because the US dollar appreciated. And it appreciated by so much that the gold price didn't go up, but it went up in a lot of currencies. When you look at Australia at the top, for example, 25%, right? And that's what matters, right? So gold can protect investors from losses, and it really helps to look at different currencies to understand that. So finally, I can also look at the stock market in local currency in a crisis here. So there's a crisis, so the losses are minus 10%, minus 20%, or minus 30%, and then link that to gold in local currency, and you see a negative correlation. This the not so steep line is the OLS regression line, and that one is, the other one is a 90% quantile from a quantile regression. And we see a negative correlation, which means, well, it looks as if the larger the stock market loss, the higher is gold in the change in the price of gold in local currency. And why is that? Well, it is because of the currency effect, right? And so here it's almost like safe haven perfection. The larger the stock market losses, the stronger gold safe haven. Of course, it looks like perfection, but the real reason could be that international investors leave local stock markets, make the drop in the local stock market stronger, which also leads to depreciation of the local currency, which then helps gold. But if international investors potentially hadn't engaged in a flight to quality, left the market, maybe then the losses wouldn't have been so big, and then we don't need gold to go up that much. All right. Good. Now, I was also asked to talk about ESG and sustainability. And here we've seen that, for example, BlackRock has been a strong advocate of this and made statements such as this, that if you do integrate sustainability and ESG, that this helps investors build more resilient portfolios, right? Which is somehow linked to what I just explained, that of course also gold seems to help investors to reduce their losses, right? And it even helps them more if they need it more. So I want to highlight a couple of things here, because it has attracted a lot of attention, that and there was also a lot of strong claims associated with that. For example, that when you look at this here, ESG index funds are outperforming mostly, well, and then they said Morningstar's environmental, social, and government indexes are beating the market across most countries and categories, but less so in the US. Well, that has changed now a little bit. Initially, I remember that in 2020, mid-2020, the claims were much stronger. So they wouldn't have said the mostly, and they wouldn't have excluded the US. And it was also, when you look at it, there's also a lot of academic evidence here, more and more, that says, well, you know, it really depends on when you look at what's the sample period. And just by reading this here, the lower paragraph, where they claim, well, ESG exchange traded funds, they have outperformed the market between March 5 and 2020 and 2021. But, you know, it's rather selective, right? March 5 over 2 years. Well, if you move that a little bit to the left, a little bit to the right, then it could be very different. And also the outpacing is small for some, maybe a little bit larger for others, right? But I want to go a little bit more into detail before I show you this, that there's ESG is all the rage, right? Like everyone talks about it. But so this article here by Matt Levine from Bloomberg also highlights that what does that mean, right? And why would that lead to higher returns and more resilient portfolios? So one key thing here down there is this would cost. So if a company decides to be less polluting, well, they could do that, but that would cost more and reduce profit margins, right? So that makes a lot of sense to think like, well, you know, if you do something for the climate, if you are more if you pollute less, there's also costs associated with it, and that's something that that we also have to see. Of course, if all investors go into ESG, they may neglect these costs, and there may be other costs if you don't do anything. But initially, there should be a cost, and that's something we have to consider. Right? So that's a nice article that we don't have, I guess, time for this. So I looked at a couple of things to highlight that it's not so straightforward that just because you do ESG, then you have lower losses or you have more resilient portfolios. So the hypothesis is ESG a hedge against extreme losses? That is something that is often claimed or put forward. And what markets or companies perform best during the first COVID outbreak? So here, when we look at the S&P 500 and Wilder Hill, the clean energy index, which is used often as well, clean energy suggests that it's good for the environment, it's good for the climate. You see that this the Wilder Hill index, the orange one, outperformed the S&P 500. But then, if you go back to what Larry Fink and others said, and many people claim that something that is like has in this case the environmental ingredient pretty strong. How did that then perform in a crisis? And you see here that with the COVID outbreak, the Wilder Hill fell by more than the S&P 500, right? Which is not really consistent with the claims that, well, if you do here, if you do E and S and G, then your losses are smaller. We can also look at, for example, the S&P 500 subsectors, and then here, when you think, okay, which sector is really outperforming? Here again, this is the crisis, the initial outbreak focus, and what is outperforming is information technology. So, well, you could now tell me, it's a little bit from backwards induction maybe, but is information technology the sector with the highest ESG? Would you think that? Well, if you think of Facebook, Facebook is doing a lot of things that some people consider not really ESG or not worthy of the highest ESG rating. So here, information technology is the highest and energy the lowest. Well, that makes sense. Maybe that energy has the lowest, but then if you remember what happened to the oil price, then that could also play a role there. Right? We could also then look at index constituents. What do you expect there? If we can compare India with Australia, Saudi Arabia, and Switzerland. I put Saudi Arabia here because they have a lot of oil. India, for some reason, didn't perform too well. It's just a country perspective. If we compare India with the other BRIC countries, so Brazil, China, and Russia, it's also interesting that India performed better than, as a market as a whole, better than Brazil, but worse than China and Russia. And I think that's interesting. Why is that? Right? Is it maybe harder to socially distance just because of the large amount of people in India, which also belongs to China, or also true for China, but are there other issues that make the whole thing more difficult, which may explain why it performed better than Brazil, but worse than the others? Now, if we go, let's say, focus on firms, if I go, for example, look at the DAX 30 biggest stocks and then rank them, the performance during that initial outbreak, then I see that the two best performing firms, Qiagen and HelloFresh, I'm not aware that they have any particularly high ESG rating. HelloFresh is a food delivery service, which makes total sense, right? COVID hits, and so which company does pretty well? Well, food delivery, right? So because you don't want to, there's lockdown, you don't want to leave the house, and then stock price went up, right? Qiagen is they're somehow linked to DNA analysis, vaccines, mRNA, also makes sense that they perform better than the rest. But it's not clearly ESG, right? Now, if we go to I looked for some markets with not too many stocks in there. So for the Swiss stock index and its constituents, we see that Logitech, many of you know that they produce computer mouses and stuff. Swisscom, communication, well, they perform best, but ESG rating? Yeah, of course, that's the next step. Like, do they have the highest ESG rating? But I would argue that, well, it's more in a lockdown, you have to use the internet more. You can use the internet more. You need computer stuff, right? And that may explain why they outperformed. And now going to India, here we see for the Nifty 50, it also dropped, similar to what all markets did essentially. And if I do the ranking there, well, one of the worst, you all know these companies. I know Tata Motors. I have a feeling that I know what the State Bank of India is, right? So they didn't perform too well. But then we have the top performing firms. Again, over that period, the initial drop from late February to mid-March, Chipla and Sun Farm Industries. So it's pharmaceutical companies, right? Okay. Pharmaceutical companies have the highest ESG rating? I don't think so. I would be surprised if they had. So it's more other reasons, right? And there is academic literature that says, well, what is needed in the outbreak, right? What did investors, what did consumers, what did people need? And then is that then reflected in the stock price? And that's what we see here. So conclusion, ESG does not seem to be the main factor for less severe losses, right? I mean, it's pretty easy to find other reasons, right? Remember the food delivery service. I mean, why would that have the highest ESG rating? I would rather be the contrary, like, because I've heard of a lot of food delivery service that they really underpay or don't pay their employees well. So that wouldn't get a high S rating or G rating, right? But it had the highest, was the best performing stock in one of the indices that are presented. So that just highlights, well, you know, we have to be careful, and it really makes sense. And it's a lot of fun to test these hypotheses when Larry Fink from BlackRock or other people tell us, well, you know, like the ESG portfolio is the thing you have to go for, right? Maybe not, or maybe it's another factor that is actually correlated with it. And so descriptive analysis, which is what I've shown you here, is, I think, like a good basis for potentially a much deeper, maybe with the use of econometrics that you have to do. But what I've done here, descriptive, just taking the data, is a good basis for much more. So quickly, research strategy. A hammer and a nail, right? So that's a hammer and a nail, and that's a big hammer and a smaller nail. And so I want to start with this analogy, so because here it was suggested that I talk a little bit about research strategies for PhD students or students and what I think is important. And I think it is important to realize what a hammer and a nail, maybe econometrics and data, the analogy is. So is the econometric technique right for the data? Because a lot of researchers in these days, they download some package from a software program, R or Stata, whatever, and then they have some data, they press the button, and then they have something, right? But is that really the right hammer for the data? So clearly, it's nothing new, but do you have an interesting research question you want to analyze? Is that really what you have, or do you have just a data set and you want to do something with the data set? Right? You have a nail, you found a nail, and it's like, okay, now I need something to treat the nail, right? But I think it would be better if you had a plan. You want to build a house, you need some timber, nails, and a hammer, right? Or you want to fix something, right? And that's sometimes or often, I think, when I get papers to review, what I think is missing. So do you want to compensate the lack of an interesting research question with the largest or most fancy hammer ever used, right? And then here, the largest or most fancy hammer ever used is an analogy for, you know, very sophisticated econometrics that is really hard to understand from a reader's perspective. And sometimes not even clear that the authors fully understand it because, well, again, today, it's so easy to download the package. And so I think it is really important to see that, well, what is my question and what is the best tool to answer that question? So it could go on like, do you have a hammer and no nail, or you have a nail but no hammer, and so on, okay? So one example that I recently read, I cut everything to make it not clear which paper I read, but that was a paper that I had reviewed last week, for example. So in this paper, we examined whether the economic policy uncertainty index can predict the cryptocurrency returns for countries. And so that paper wasn't really clear why the economic policy uncertainty should predict, you know? I mean, it sounds much better that it's like do pizza deliveries predict crypto returns? Okay, yeah, that's obviously nonsense. And I know that a lot of papers do this, but and you can do it. But I mean, that paper that I read didn't really explain why they thought the economic policy uncertainty index was the best thing to use to predict it. What about all the other factors that you can use potentially? Good. So another example that's very recent, based on an IMF report, crypto stock correlations. So you've all maybe come across papers that do this. That can be interesting, but it's not always explicitly stated why that is interesting. And a recent IMF paper has highlighted why that's interesting, because the IMF clearly has the focus is on the policy questions and the regulatory issues. So why is this interesting? What is the research question? What is the best data that I can use? And what is the best tool to analyze the data? So if I download the data, like quickly, Bitcoin in USD, S&P 500 or MSCI World here, I plot them, very important, I think, to get an idea. And then I see here that was COVID, where they both fell. It looks as if the MSCI World fell by more than Bitcoin, but that could be misleading because Bitcoin is just very volatile, as you all know. So in here, when we look at the 100-day rolling correlation, which is actually what the IMF also did, and what's industry practice, then we see like a jump here in the correlation, right? And that's potentially worrying for regulators, policymakers, maybe also investors. And if we use something more sophisticated, the DCC is not necessarily industry standard, but it's something that a lot of researchers use, a dynamic condition correlation model. We see that clearly, because it's not a rolling window, it doesn't have that plateauing thing here at the end of the sample. Somehow plateauing, but not less obvious, right? And also even the scaling is different. So it makes a lot of sense to look into these. Why are the two different? Industry uses the other ones. They cannot be so bad. And even if it's bad, then it also makes sense to understand why industry is using it, or if they're using it, maybe then to understand if the DCC is really so much better. And so why is that correlation interesting? Well, because it says something about the systemic risk of crypto investments, right? Because if the correlations are higher, then there's more risk coming from crypto potentially. Even if investors hold the S&P 500 or the MSCI World ETF and crypto, and the correlations go up, higher risk, right? And that could be a systemic risk, and that is something the IMF is worried about. So that tells us that, and then you have a motivation for the analysis to look at the correlation, right? And then you could also wonder, okay, why does it stay high post the March 2020 shock, right? Because it went up, the crisis in mid-March, and there was this big spike. But then why did it stay up there? You know? And that's something, well, if you then go back and you think about, well, after that, they both went up, right? So could that be a coincidence? Could it be spurious that, you know, if two things fall extremely, that if they then like reverse that big fall over the coming month, is it then maybe natural, expected that the correlation stays up there? You know, I mean, that's something that is interesting, and that is then really worth it to elaborate, like to go dig deeper and better understand that. Right? So I thought that the IMF statement here that you know, it's higher now, it's really concerning. Yeah, maybe. But it's also maybe premature, because you can see that it's already coming down a little bit, right? So maybe that's really just like an effect of that initial drop. And maybe next year we see that, well, it's a little bit higher than it used to be, but it's not that high that we have to be concerned. Good. So takeaway, if I just focus on that ESG that I talked about, is it really ESG that helps reduce impact of COVID, or is it maybe something else? Is it really that stuff that people need, you know? Food, food delivery services, computers, Netflix, all these things that explain why some companies did better in the crisis than others. And is that maybe not really related to ESG? Is that maybe a very strong claim? And then the other thing that I talked about was the research question, the data and the tools. And some of you may also want to remember the hammer, right? Do you really need that super fancy hammer to put in that nail, or is a is it maybe better to put more effort into the research question and the analysis? And as I suggested here, you have the correlation estimates, and you compare them, the more sophisticated econometric one, the TCC, with the industry standard, but then you also look at, okay, why is it now higher than before, right? Not just the econometrics, but also the analysis after that and the interpretation. All right, thank you very much. Again, thank you very much for the invitation. It's really an honor, and I was very happy to receive your invite. Thank you.
Thank you, sir, for sharing your valuable insights on how financial institutions and markets are tackling the pandemic and how the future looks for the world by explaining the various macroeconomic indicators. It was very enlightening for all the attendees. The next guest of honor is a luminary in the field of business and finance, Dr. Muhammad Hamid Uddin. Dr. Muhammad Hamid Uddin is the head of business and associate professor of finance at the University of Southampton, Malaysia. He received his PhD in finance from the National University of Singapore and taught at the same institution. He also taught at the University of Dhaka, Prince Sultan University, the University of Sharjah, and Taylor's University. Dr. Hamid held several key administrative roles in the past. He was the director of the doctoral program at Taylor's University, Malaysia, and a member of the College Council for the College of Business Administration at the University of Sharjah, UAE. His current research focuses on cybersecurity risks and bank stability, corporate governance and business conglomeration, Islamic and socially responsible finance, and microfinance. His earlier research covers government share ownership, corporate risk-taking, IPOs, mergers and acquisitions, dividends, and capital structure. Dr. Hamid has been serving as an associate editor for two prominent finance journals, Studies in Economics and Finance and the International Journal of Islamic and Middle Eastern Finance Management. He is an active member of the British Accounting and Finance Association, BAFA, British Academy of Management, BAM, and Financial Management Association, FMA. Dr. Hamid is the recipient of the Texas A&M International University's Best Paper Award in Financial Markets at the 2020 Southwestern Finance Association Conference. Sir, we are very pleased to have you with us. I now request Dr. Muhammad Hamid Uddin to deliver the expert's talk.
Okay, let me hear. Okay, thank you. It's really a great honor for me. It's my pleasure to be able to present one of my latest research to the audience. The one that I'm gonna presenting today here, it is one of my ongoing projects that which I have taken probably 3 years ago. It's a collaborative project. You can see in our team, we have multi-university teams from the UK and from Malaysia here. And the topics that I have chosen, financial stability on survival of the microfinance institution. And I thought that is quite relevant with the topics that, I mean, sustainability of financial institutions. And the issue, and I tried to look at another interesting aspect over here is the role of donations. The issue that I take up probably 3-4 years ago, because I've engagement with the central banks around the regions in Malaysia, in Singapore, and also in my country here. And I saw that there are a lot of cases here, the microfinance, they start their business, and at some point in that down the road, they just failed, liquidated a lot, penny. And issue was really very tricky from the donor's perspective. There are, so that is one of the key area, and the donors really commit a lot of different fundings for these institutions, but probably at some point in time, these institutions is just, liquidated. So that's a tricky issue. And then we take up these collaborative projects funded, and there is a PhD students also under these projects is going on. And that's why it's a quick background here. But I'm trying to show you one of the important things here. then you can see that microfinance institutions struggle. I'm going to show you a few things. Initially, I thought that, oh, it is something that we are thinking from the policymaker perspective. But what I see later on, we explore, it's actually a global concern. You can see here carefully. The economic times industry, microfinancial institutions are struggling for survival. Here's why. I mean, people is trying to find an answer, but there is no answer. Okay. And it's not one. There are many. And that you can see here. And the one, with its reputation breaks up microfinance to survive. And also, we can see that there's a lot of debates going around whether microfinance is really charging too much interest rate, a lot of criticisms around the world, although microfinance in existence probably more than 4 decades now. It started 70s, Professor Muhammad Yunus, and all over the world, but it's still a group of people's always against microfinance. Some people say that, yeah, debate going on. So it is, I would say that the debate just starting from the inceptions, the very, very beginning. There is a lot of issues behind it here. And you can see, with its reputation stack, microfinance sector is struggling to survive. And I had the engagement with the World Bank also, to see that, I mean, this is an issue that why is this issue? Because my research is actually fundamental research. I'm not looking at the country, what's actually the benefit of this society. Then Stanford, the report I can see, microfinance missed its mark. And this is very much relevant when we can see from the World Bank, sustainable development goal, and the different types of financial institutions, traditional banks, microfinance, alternative finance, a lot. And now the fintechs, P2P lending, crowdfunding, so many things coming up. But the microfinance, good or bad, yes. I mean, there is a lot of the evidence of non-survival, but still microfinance probably is called the time-tested. Time-tested, the model, the financial intermediation model, they have good and bad, so it is there. But still a lot of criticism going on. So that's why we take up these fundamental research projects. It is not an applied research project, it's a fundamental research project to ask the question, fundamental research question, why? What is the issue? Yeah. And this is the thing you can see here, even in the Guardian reports, okay? That also you can see, yeah. So this is the issue that all over the world we see that this is the concern. So we try to figure out this particular concern. So try to find an answer. So, and we had a lot of debate, discussion, the policymakers before I take up these projects to collaborative projects in a way. Then, yeah, the funding and everything is come forward. So, okay, let us start in to see what is the issue here. But we try to link with the donations. Donation is the donation funding is the part of MFI business model. We need to understand very carefully. The traditional banks, or I said that commercial banks, and the microfinance both do the same work, financial intermediations, but albeit the different business model. Yeah, the traditional banks that rely on deposits, which is the pooling of the surplus from the economy. Yes, so the microfinance also do the same. They receive the donation, but donation is also the surplus of the economic surplus here. But I mean, from one country or another is the taxpayers' money in all may not be in developing country of the developed, wherever it is. So it is taxpayers' money. So it is a surplus and all. But the banks pull the surplus through the deposits, but microfinance pull the surplus through the donation channel. So the channel might be different, but basically both are surplus. I mean, they're coming to these productive sectors. So we try to link that's the very fundamental question. So why are we saying that? And the two different business models, the bank and microfinance. So bank have established banking model, the business model. So microfinance called the group lending, no collateral. There are so many things. We in this paper works, we did a lot of the theoretical analysis, understanding to see what is an issue, what is the critical factors behind it to see that the microfinance business model is actually there is a concern for what I call the economic theory of the economic of scale. That is a very fundamental question. I mean, we try to link to the classical economic theory of the fundamental theory of economics, that the skill matters. So, and also these are the issues we try to figure out, the certain issues that, okay, if given the business model they are following, if we push that, if they channel the fundings and microfinance institution will try to, expand their business. The moment they try to expand the business, okay, they cannot survive. I'm trying to give you an analogy. For example, we may have a fantastic Mercedes-Benz car, fantastic car, but if the road is so badly, and if you put it in a speed, cars get an accident. So the question is a very fundamental question. The donations is the global donors that channel the money. So the business model really have some flaws in it. The regulatory frameworks in the country is really some issue here. So if you're putting the donations and microfinance will speed up their business, so naturally, suddenly, there is the probability that they're going to do the accident. In this case, the liquidations. So this is the underlying, the fundamental research questions in these projects we try to figure out. And the prior evidence shows that over the last 40 years, that less than 30% of the MFI are operationally sustainable, because these topics of the conference is called the sustainability of the financial industry. This is the evidence, the global evidence. The rest of the microfinance require the subsidies for covering costs, financial loans, and so on. So this is the issue. There's a puzzling questions that we try to figure out. Why microfinance the lack of stability? That's the one question. Why? Okay. And do not survive despite receiving the cost-free donor funds. So meaning that if you try to see, deposit has a cost, but donation doesn't have the costs. But still you are giving the free money, these donations, but still the microfinance not really able to survive in the long run. Only 30% survive, the remaining not. So what is an issue here? So there must have some sustainability issue as a business model, which probably need to think. I had another paper on that. That's the comparing that part. So this is the second paper. Here the third paper is also the another one. So that is the key fundamental issue we try to address in this particular paper. Just one question: why? And in doing the key research issue, try to find out. As I explained, the point here is that inherent systemic, or we used to call the systemic problem in the business model itself. I'm not saying that microfinance is bad. That's needed. That's definitely needed for the global poverty alleviations and everything. But we have to have really, it is a time for us to really do a fundamental research on the business modeling, microfinance modeling. Professor Inus, I think they have given the foundation of the microfinance 40 years ago. Now it is a time for the new researchers to start and do, fundamental research to improve that, to see. So here is an actually issue lies. We try to see that the inherent problems there. My objective is not to criticize. My objective of the research is to find out issue and improve the things for the future mankind to improve that. And so what we have identified is that high business exposure leading to the higher operational cost. As I mentioned, that economic theory, law of diminishing return, everything we discussed inside of here. From accounting perspective, we have a leverage, operating leverage, and all these issues coming here. Another tricky issue that we touched in this our work is called the moral hazards problem. The moral hazards problem, what is it? When the donors giving the fund, look at it very carefully from the economics point of view. When you say the donation, the savers, their surplus money, the donors giving the money to go to the poor. But look at when the donations coming to the institutions, but they're giving the loan, not the cost-free. So meaning that the donations, the institutions receiving, but they're giving the lending. They're not really, transferring that way. So that means the donations money coming to an institution and they're doing the business, as long as microfinance is a business thing. So that is another debate, whether microfinance is a business or not business. Okay, that's different debate. Certainly, microfinance need to make profit for their survival or whatsoever. So meaning the donor agency is not really giving the money directly as a charity or whatsoever. Instead, is giving to the institutions where they are doing the business or not business, whatever, NGO, they're doing that. So the moral hazards problem, there's one part. Second part is that when the donations money, the fund is given, when the microfinance failed, are they accountable to their donors? Probably not. There is no legal frameworks globally, no country level framework globally. So I would say whoever the microfinance owner, they would love to see that company dissolved and take the money out. So because they're not accountable, neither accountable to the money provider, but if the bank failed, accountable to the central bank, accountable to the depositors, accountable to the shareholders. But if it is a microfinance, because ownership is the NGO, the funds coming internationally, after doing 2-3 years of business, and if they, liquidate, they're most happy because they're not accountable. Neither accountable within the country law, nor accountable to the donors and international. That is one of the critical debates when actually I was sitting with the different international bodies and different things here. And this is one of the governance issue, that moral fundamental issues coming here. This is the area that we have to explore. And that is called the lack of accountability. Accountability of whom? Accountability of those who are actually the developing and creating the microfinance institution. So these are the issues that we thought that, if I would say, explain, is a disadvantageous for the poor, those who are supposed to get the benefit of the donors, but advantageous for the entrepreneurs. Yes, they love to see, okay, they do business for 5, 6, 7 years, fantastic, we get the business done. So because they cannot blame, because if the auditor comes and audit everything fine, we make losses, who can do this? But if they make losses and fail, but they're not accountable. So this is the legal, the framework issues, the ethical consideration issues remains in the systemic problems. What we would see the issue. So these are the fundamental, the theoretical inputs in our research that we try to put in here. Then, because of this, what you see that counter-performing the effects of donation. So what happened, given the structural problems in the business model itself, and the moral hazard issue because of the regulatory and the legal frameworks, because the donor money coming from the Western countries in our emerging countries, so they are not accountable. Given this scenario, we would see that the objective of the donations to improve this microfinance population is not happening here. So that's the fundamental questions. It augments the existing risk factors of the higher lending capability. So meaning that if you don't have many, that means if the institution really not have the capacity to deliver, in that condition is the donor giving the money. So really it's basically augmenting the existing, inherent risk factor of the institutions, not to survive. So the ideal question, we have a bad people, okay, bad guy, I'm giving the donation, actually he will become even more bad. So until this is the situations that we would like to see. So become the persuasive factors of the MFI's instability and failure. So this is all the debates and arguments we bring. So actually, we did not really go into the straightforward getting some data from here and there and showing on that. We try to go into the deeper of the topics and deeper of the issue. What is the issue? What is this thing? What it is? What is the problem? Figure it out. Then we try to link to some theoretical insights and thoughts. Yeah, we all, I think probably I touched on that. Financial intermediaries as an agents, we all know that. Information asymmetry, and we all discuss about that. And the MFIs are the financial intermediaries beside traditional banks. So if you look at the financial intermediation theory that evolved, historically, that basically channel the money from the surplus unit to the deficit unit. That's the fundamentals of the financial institutions. Yes. So the microfinance institutions, they are time-tested. The business model. I would not say even so that the P2P funding, lending, whatever, these are not the fundamental business model. Is basically a technology fad. Just technology come up, they make it easier for you. But it's not the per se the separate alternative financing model itself. It's basically the technology make the things easier. So as far as the business model is concerned, obviously one is what is so that is the existing banking model. The other one is the microfinance, the group lending, and all this stuff that we have it here. So these are the two fundamental the business model that exists in the paradigm of financial intermediations. So what I would like to argue from the theoretically, the microfinance institution play a distinctive role in this intermediation process. What is that distinctive role? That means that is the popular word they said that, okay, what do you call that? Collaterals. So because the poor people, marginal peoples cannot go to the traditional banks because they don't have the collaterals. but microfinance make it easy for them, so they can give it here. But in another paper, we have shown that actually they did not do any fundamental change, because after all, poor is poor. Basically what has happened, the credit risk converted to the business risks. So that's the swap between the two categories of the risks. So in our another paper, we fundamentally looked at it, because fundamentally, if you say that from the theoretical perspective, okay, if you are, your credit worthiness is less, you have to pay higher interest. So basically that paradigm is always remains the case. So even though they develop some mechanisms through which they are able to the credit access, but in terms of the cheaper, no, they cannot get it cheaper, because we see that if your credit worthiness is less under normal theoretical considerations, that you have to pay higher price. And indeed, microfinance borrowers is paying a higher price. I have another third paper on that one, why microfinance even doing it. So broadly, the remains the same is SQR1, actually, if you want to look at this carefully. So the mobilizing the savings to the marginal borrowers, so donation comes, I think that's already, yeah. So we have a conceptual frameworks that how we put through here, the donations coming, fund transfer, intermediations, and the more the fund donations coming, they go for the more loan disbursement. The more their loan they disburse, more operating costs, because it's the fundamental crux, the aspects of the microfinance. Because for every dollar of lending, it is proven, already I have evidence, for every dollar of lending, microfinance has spent more dollar compared to the traditional banks. As simple as that. So if that is the case, if microfinance give $1 loan, traditional bank $1 loan, microfinance for $1 loan giving, the operational cost is high, even though their interest is zero. Their funding cost is zero. So that is the proven that we have another papers and summations is doing that. So meaning that even though the interest cost or the funding cost is zero, but the other overhead cost is coming, putting in the basket. So overall, it's actually, so they are in disadvantageous positions. So that is the critical thing. And that's ultimately inherently leading to their non-survival reasons. Okay. So then we have a study hypothesis. Probably we discussed on that. I think already we discussed the key questions here. The donation increases the liquid funds for lending. So that means you have a fuel in your car is good, then you try to speed, but road is problem. And if the bad road, and if you speed the car broken, get accidents. So that's the analogy, and where from ultimately we leak through that donation adversely affects financial stability. It is not the donation per se. Donation is good. I'm not saying the donation per se. It is happening that the ground creates such a way. So if the donation comes more, that's really cannot give the results. And survival. If that's really make you financially unstable, then you'll not survive. That's our next hypothesis draw. The higher operating cost minimization enhances the survival probability. So that's it. So higher the level of donations can further contribute to the failure here. So the donation increases the probability of survival. So meaning that apparently people might think, how is it possible? Different scholar could differ with us. Yes, we love people to differ. But the argument is that, okay, I'm not saying the donation per se, but the ground has created such a way, the more that you put the donation in here, it actually get the results out. But if the circumstance is okay, donation will give the result. And I'll give you the evidence that why it is the case in the context of the India. So this is the issue. And this test is, yesterday actually, Raghu, I mentioned that 68, it's another paper. So this initially, we have a global country, 119 country in the sample. We have taken all these samples all over the world here, and we get the data from the World Bank of this data. Almost all countries where the microfinancial institutions are operating and where the donation data, donation receipt data, and everything is reported. We get this from the mixed market, the World Bank database. All this information is here. You can also, have this database. So it is possible. So we can see that from India, we have about 222 microfinance. I think I don't have the list there, but we have the list in our the samples and everything. Yeah. So this is the the huge samples from all over the world that we have conducted this study, and overall 2,653 microfinance institutions, and we covered the 20 years period, quite a longer period here, and data source is the microfinance exchange, the mixed market, the largest industry data source from MFI managed with the World Bank. So so data is available to see that how the things is moving on. But and as I said, the simple characteristics, MFI, I mean, we did not take all MFI, where is MFI really doesn't disclose this data, how much donation they received. So if they disclose exactly how much year by year the donation they received, only those MFI we picked from the World Bank database here. And it covers all over the world, the different regions, South America, Asia, North America, Oceania, everything, all countries. So we can get the broader pictures from the all over the world, the global, to address, fundamental questions. So, well, this is the our analysis model. We used our probabilistic model. I'm sorry, the first two we stopped. We have done this our wellness model. Of course, we done in a different settings. We use the Z-score. Z-score is the measure of financial stability of the financial institutions. In different research paper, you can see it is there. And we use the donation to assets, the log, and several set of the control variable we use. And we also use the survival model, which is the probabilistic model we use, and also use the different alternative model, the Cox and Cox models and different model hazards of the model. And there are our dependent variable in this case is the natural log of the Z-score, which is financial stability model. And in the survival model, so we have done the two tests, whether the donations really be affecting the financial stability of the institutions, number one. Number two, things we said, okay, if their financial stability is the cause of their demise, cause of their death. So that is the thing we try to figure out. And okay, an independent variable obviously is the main one, is a log of donations. Of course, a set of control variable, institutional level control variable. Since we have a multi-country data, global data sets here, we have the country level control, because I need to set up the country control. And also we also GDP inflation. In addition, we have used that country and year proxies so that we can control for the country level effects for unknown and in community analysis. So estimation procedure also we have, this is the estimation procedures. We have stability, the models, and OLS, fixed effect, GMM, all we checked the different, the setup of the things. And we use the survival analysis model also, the probability, Cox, and the competing hazards, so different alternative, the robust tests analysis that we have done to see that our results whether it stands or not. So I would like to show you the first results. This is our first results. The first results, I'm going to presenting all three estimation model, that is OLS, the fixed effect, and GMM. Actually, we also test all other models. It's okay, but broadly we try to bring this the OLS is the base model. Of course, there's a lot of criticisms about the OLS in terms of their consistency of the estimations because of the econometrics issue, indigeneity issue. There are a lot of econometrics issue. Yeah, it is there, and GMM covers is there, and later on we have captures the procedures to address those. But the key results, if you want to see here, the log Z-score here, sorry. The first one is actually dynamic GMM. This one, all negative coefficients. That's very clear. From the global setting, if you'd like to see global setting, our baseline results. Yeah. So the more the donations remain, given the other factors is there, actually company's financial condition is getting worse. But remember, I'm not saying that the donation per se is the reason, but whatever the reasons, the fact is that given the conditions, the more the donations the microfinancial institution is receiving, in the long run, the microfinancial institution is getting worse actually. So, that is the fundamental question. So this is the core issue that you'd like to see. Yep. And then we have tried, we have done the several robustness analysis to say, some microfinance do profits, some microfinance don't. They are purely NGOs that try to see. So we look through all the data sets and everything here. And this information is also available in the World Bank database, which microfinance is, they identify as the profit oriented, which is not. So which is NGO and so on. So these are all the different categories that we put up here. See, first of all, we can see that whether they make profit or not make profit, outcome is the same. So that means it shows that it is the fundamental structural problem of the model itself and the governance issue that we are talking about. And no matter whether if it is the NGO, non-banking MFI, rural bank, credit union, all the cases is brought the same the results. So this is what, I mean, this all the classification come from the World Bank. So it is the results that we get. The next results we've done the quantile regressions. Our purpose of the quantile regression is different because quantile regressions is non-parametric tests, because the researchers said that in a OLS is a parametric test. So there are a lot of issues about heteroscedasticity, autoquote. There are so many other econometrics issues, but that's why we apply the non-parametric approach to see at the different quantile how the results actually come out. So the 25th quantile, 50th, and 75th. So the results broadly similar. In all cases, is the negative. So meaning that that's what the key question, the fundamental research questions that we addressed in the beginning. They said that, okay, there is some structural problems in the model itself and governance issue. In these conditions, there are no more donations coming in here. So meaning that in the data set, if you go inside the data sets, you see that and across the different quantile, it come up with the same. That even if I use the different other quantile, same results, whether it's the 10th quantile, 35, all of the different quantiles the same. So that's the fundamental thing. So meaning that both parametric tests and the non-parametric tests is come out with the same conclusions of the results based on the global data sets and also controlling for the different country sets in the data sets. Yeah. So okay. So this is the baseline model. So after establishing that, yes. So given the scenario that prevails globally in the context of the microfinance, if donors agencies that provide the more donations to the institutions, it's actually institutions is not getting better. As an institution, their instability is getting worse. Then what is the conclusion? Are they really affecting their demise, affecting their liquidations? That's the test we done the profit model. We have done the test model here. One is our profit model. We have a Cox model and competing hazard model. So this is every model has its own benefits and that, but it is not that we apply the one model, we apply the different the model to see. So fundamentally you can see here is that the more the donation the receives and eventually the probability of dying is high. That's how we have done this. Then we have done kind of the more diagnostic study. Diagnostic study is that, okay, we are arguing that if the microfinance, whether the demise or the death of the microfinance is the reason their financial condition or something else. Whether it is the financial stability is the reason or some other reasons. So that is what we try to figure out here. Then we can see here the donation MFI survival, the role of stability, whether they get unstable. So the donation to assets, yes, that is the survival, the affecting, and Z score, which is stability. Then we saw the interactions variable to see mediating role. And once we include this interactions effect, the model number 2, say that gets significant, other to get insignificant. So meaning that the microfinance is, microfinance non-survival or liquidations, it's because of their, non-stability, financial matter. And their non-stability or their financial instability is triggered by the channeling the funds, the donations coming through here. So we prove in this study over here. So still our study is going on to see that what we are doing, what I'm doing. But now I'm trying to show you another interesting results. The global results. And you will find a very, very interesting result. Since we have 119 countries, we have the results, but I cannot show here is all country results, the country by country. We picked only the top 10% country in the world. Of course, India is the number 1 in terms of this global data set here. So we have selected the top 10% of the country in terms of the market size and market share of the microfinance in the global context. So in our one, we rank the country India #1. I don't have the exact ranking of the country here, probably, yeah. I mean, so in terms of the total number of the microfinance institutions operating and the size and everything here in terms overall. So these are the results. And interestingly, you can find interesting result in all cases negative. See, consistent, but India is positive. That's kitty. And so the Asia, Africa, I mean, East Europe, Central Asia, Latin America, Caribbean, MENA, South Asia, all the South Asia, I mean, Bangladesh, India, Sri Lanka, and all the broadly. But India's results is unique. Russia's result, but India is 1 star, India is 2 star. I mean, you can see that's pretty tricky. When I see the global results, context is that yes, the most donation coming. I really don't know when. I mean, I show that Indian microfinance institution is really struggling. But if the donation is the reason, but at least the studies are that donation is not the reason for India. So that means India's case is different. That is the one area I would encourage the researchers in India and institution to pick up this area, to see where is the actually, I really don't know, probably India really went through some, fantastics, I have no idea. I mean, the microfinance regulations, the process or economic, that's the probably area to see why and how India's results is different, and it is a good side. That means if really this is the case, the donor agencies will be interested to more work with India. That means the giving the donations to Indian microfinance is safer than the giving donation to the rest of the world. In the rest of the world, giving microfinance institutions probably is going to die, and they're giving the donations to India. So it could be the opposite. So meaning that even though Indian microfinance institution is really struggling, that could be the other reasons, not probably that this is the reasons. So I don't know. I mean, this is what actually, when we started these questions come up. So there is the new dimensions area to come, and probably I leave it for the academics and the research in Indian context to see, can really, and even different Indian agencies to see that to take up the projects and the funding project to see. And that could be the lessons for the global world to see in terms of the microfinance to see. And that's why yesterday when I thought the results, that could be interesting results for the people to see that how it is going. Yeah. So the contribution and implications, obviously I try to look at first of all from academic contributions, because I'm academics, and is the first empirical evidence on the impact of the donation. It is the first one. No such a study before. The role of donations on the survival, set aside other factors. Yes, there could be other factors too. So it is very clear. So it is doing that. So it's a great policy implication. Great. I mean, that's already very clear. Efficient planning of the credit operations by MFI managers. I don't know. I mean, once I get the different results for the India, we really need to look at it, this issue again, to see whether my theoretical setup is the problem, or the India has developed something regulatory. I mean, even you can take the Indian regulatory thing that this results is showing this way. So we have to look at the concentrate on the cost. Obviously, the cost efficiency is matters. So we really don't know. I mean, still our study is going on to see whether the survival is linked to the India's cases, that or not. So the cost concentrate on the cost efficiency, then the securing the cost-free donation. So, other than the India, I don't know, but for the global context, is that if microfinance really need to survive, it's not the source of money. It is the questions that they need to really rethink about the business model to see how really they can, from the economics of scale, the theory, they can reduce their cost of operations and come to the part of the banking level. So donors need to be more vigilant. I mean, if really this is the case. Okay, so and the selecting the institution and funding durations. Why we say the funding durations? But evidence shows that, in our descriptive results, most of the institutions actually liquidate after 7 to 8 years of their thing. So if the donors think, okay, we are giving the donations, they are already 7th year, it is better not to give the donations because sometimes they're going out. So it is opposite result, or they cross almost the 20, 30 years established institution, fine, but an institution started beginning still okay, but institutions, those who are in the age of 8, 9, 10, or 12 years, that's very risky because most of the institutions actually liquidated around this time period. This actually our descriptive results that we proved that way. rethink the outreach mechanisms, equity funding instead of the credit to the poor. We need to think about the process carefully. The government policy measures ensure the accountability. That's the another point. So I think all this area I need to think from the Indian context and see that from the global lessons too. Conclusions, what are the takeaway? The role of donations MFI. I mean, it was not really studied before, so that we take up this issue here, reduce the financial stability, higher donations, the lower JET score, that's already proven, okay? Enhance the non-survival or the failure of probability. But set aside India, that's the results that is showing that. It's for the global context here. And the fundamentally associated with the business model, that's we try to see. But I really don't know whether Indian microfinance is really a different business model operating or not. So that's really need to be looked into from the global audience perspective. So adverse effect on the donations is true, all types, legal status, fine. MFI profit orientations motive have no differential impacts. Geographical variations are negligible, except India. The financial instability increases. So these are all the different findings. Yeah, that's it. Thank you.
Thank you, sir, for sharing your valuable insights on sustainability of microfinancial institutions in the post-pandemic period and issues related to the business models of it. It was indeed an enriching experience for all the participants to have learned from you. Now we move on to the final guest of the day. Our final guest is Srimati S Vijayalakshmi. Srimati S Vijayalakshmi joined NABARD in January 1988, and in a career spanning over 3.5 decades, she has worked in various departments and regional offices of NABARD. Her focus areas have been institutional development and supervision. She has played a pivotal role in the implementation of Vaidyanathan Committee report and is currently the head of Microcredit Innovation Department in NABARD. She holds a Masters of Philosophy degree in Political Science and Master in Development Management from Asian Institute of Management, Manila, Philippines. She was also an ABD scholar. She was a faculty member in the Bankers Institute of Rural Development, Lucknow, and has undergone faculty training in Center of International Development and Training, University of Wolverhampton. We would now like to invite ma'am to deliver the expert's talk.
Good afternoon. You're able to hear me?
Yes, ma'am.
Yeah. Dr. Khanna, Director, Somaiya Institute of Management, Dr. Pankaj Trivedi, Kalpakam Gopalakrishnan was my contact, Raghu Kumari, co-convener, and my, the speakers who preceded me. It is indeed, and all those who are listening to me. It is indeed a great pleasure and honor for me to deliver the special address in this International Financial Conference, which is being organized for the last 10 years. Organizing for a decade is no joke, and especially during this pandemic period. Here, the theme of the conference is so relevant, and this has been engaging the attention of the governments, policymakers, central bankers for now over 2 years. Now, I would like to go back to a very famous quote, I should say, or the opening sentence, which was written by Charles Dickens. It was the best of times, it was the worst of times. It was the age of wisdom, it was the age of foolishness. It was the epoch of belief, it was the epoch of incredulity, it was a season of darkness, it was a spring of hope, it was a winter of despair. See, this particular para which he has written was done in 1859, but this clearly reflects what we are undergoing currently. Why I even compared it is, there are some good things which are going on. The pandemic has thrown various challenges which has become opportunities for some. For example, new business models have evolved. Fintech is coming to the fore. And there are so many innovations which are happening. Even the government transfers in support of all the poorest of the poor was in terms of digital transfers, that is PM Kisan. But at the same time, it is not understatement if you say this has been one of the worst times, because people are struggling for lives. People are struggling for living. Okay, so businesses, whether large, small, have been terribly hit. So the pandemic, and every time we see that the pandemic is, coming down, it is, when we think it is on its way out, the next wave begins. Right now, this third wave, I think, was least expected by us, even though there were many theories. But then somehow we have learned to live with it now, I should say. Now, this what is very unique about this pandemic is it is not localized, it is world over, and it is an unprecedented challenge. And especially if you see, the focus initially was on the economy as a whole, with a substantial focus on the financial sector, the banks especially, because all the central banks have issued a slew of measures to tackle this crisis, to enable the banks to tackle the crisis. And in fact, you should say that there has been a positive impact of these measures, especially in the first wave. I think all of you can recall, agriculture was the only sector which registered a positive growth. It had a 3.5% growth, because largely the rural hinterland was untouched, and it was during the Kharif season. It was untouched by the pandemic initially. What was the horror story which we faced at that time was the reverse migration, okay, which was, which shook the entire country. But subsequently, if you see the second wave was, it entered the rural hinterlands, and it had a devastating impact. But still, if today we are looking at the growth, we are looking at GDP, we are looking at all factors, it is because of the slew of measures which has been brought out by Government of India, by RBI, and supported by NABARD, SIDBI, and other financial institutions. Now, government, the Atmanirbhar Bharat, the self-reliant India, it's a wonderful package. There were three tranches, and doubling of farmers' income, stronger infrastructure, good governance, a lot of things came out. The Atmanirbhar package 1.0 was mainly for recovery. The Atmanirbhar 2 and 3 aimed at stimulating growth. The total financial outlay for all the three A and B packages and the monetary measures taken by RBI is estimated to be as big as 15% or 16% of the GDP. Now, liquidity infusions took place, that was to the extent of 8.7% of the GDP. Then RBI had very, very conventional measures, that is reduction in the policy repo rate, 115 basis points, and the CRR, the cash reserve ratio, which the banks have to maintain, was reduced by about 100 bps. I think now it is increased. Then there were a lot of non-conventional measures which were initiated. That is extending lending or term funding operation. That is extending liquidity support through refinance. Asset purchase programs, which is the Operation Twist, which you would have seen in the newspapers. And there were regulatory dispensation. Then there was a moratorium given. The asset classification standstill, as what RBI says. Then there were restructuring resolution frameworks. And the overarching goal here was to maintain the soundness of the banking and financial system. Now, before I go further into the financial stability and other issues, I would first like to speak about my organization, NABARD, because we have also taken a lot of initiatives to tackle the COVID-19 in the agriculture and rural sector. Now, NABARD was established in 1982. It was carved out of RBI. Two departments of RBI were merged, and NABARD was formed in 1982 to give pointed focus, undivided attention to the agriculture and rural development sector. And our mandate, our vision is to be the development bank of the nation to ensure rural prosperity. See, now rural prosperity is such a huge word, and it encompasses all the different facets of the rural economy. And here for facilitating this, we take several initiatives. The primary being we give credit. Credit is concessional credit. It is not retail, it is wholesale. Our biggest borrowers are the state governments for the rural infrastructure, roads, buildings, bridges, schools, hospitals. Then you have the storage godowns. You name it, we have funded that in the rural areas. Then we have, we are preparing district level credit plans, which is a cornerstone for the planning process for the at the district level. We have a supervisory function because we supervise the regional rural banks and the cooperative banks, which are called the RFIs. And I would be focusing on them, on their sustainability and what we are doing in a little more elaborate fashion little later. And then we have also extended technology adoption support for the rural financial institutions, especially because the pandemic, where usually if you see the agri and rural sector, be it the microcredit or the rural banking, it is a high-touch environment in the sense, there is a physical contact which is involved. And during the pandemic, of course, the first thing was, that aspect was out. So then the coping mechanism was through bringing out enabling digital transactions. So for this, we have supported for issuance and activation of RuPay KCCs, RuPay Kisan credit cards to the farmers. And this actually had started a few years back as 14, 15, but it was fast-tracked during this period. And then we have supported banks for the rural cooperative banks for CBS, adopting CBS, and also other CBS plus like your BEAM UPI, mobile banking, the PFMS, central KYC, registry, and other enabled payment system. And since the last decade, whatever we are doing here, we are also the national implementing agency for the Climate Adaptation Fund, okay, which is under the United Nations framework. And we are also the direct access entity for the Green Climate Fund. So, climate resilient measures for agriculture is also now gaining ground. Substantial work is being done by us. And if you see our report card, we have a 6.52 lakh crore balance sheet going on to 7.5 lakh crore, probably current year. We have already crossed 7 lakh crores. We have financed 1/5 of the India's rural infrastructure. And if you see the watershed development, we are pioneers there. This is very briefly about NABARD. But here, what are the steps which NABARD has taken during the COVID initiative? Here, actually, when RBI announced certain measures, anything pertaining to agriculture and rural development was done through NABARD. And to meet the credit needs for the post-Kharif, post-harvest and Kharif sowing requirements, we had a special liquidity facility that is 55,000 crores, SLF1 and SLF2, 2 tranches. This is for RRBs, cooperative banks, and the microfinance, NBFCs, NBFC MFIs, non-banking financial companies, microfinance institution. And this is a additional special liquidity facility. Annually, we give 50,000 crores as refinance to the rural cooperative banks and 30,000 crores to the RRBs. This is funded from the shortfall in the priority sector lending of the government, or we do a market borrowing. So this is a significant initiative of ours. We also deferred principal and interest payment for repayments under this amounted to around 9 crores under the food processing sector. And because of as I mentioned earlier, the reverse migration, what we did was under the my department, the microfinance initiative department, we have an initiative for skilling the SAG members. So under that, what we did was as soon as the reverse migration happened, in order to develop skills as well as develop the bookkeeping and other management oriented skills, we increased our allocation, the number of programs we have two programs, a 3-month program and a 1-year program under both. And we focused on states like Assam, Bihar, Chhattisgarh, Jharkhand, MP, Odisha, UP and West Bengal, where the reverse migration actually, had a major impact. And apart from this, what we also said, as I said earlier, technology, we have supported for the Bharat Bill Payment System platform for online utility payment by the rural customers. Then we have immediately funded 148 mobile demo vans under our financial inclusion fund, which has benefited around 4 lakh people in rural areas. And most important, we facilitated that PM Garib Kalyan Yojana, where direct cash transfer to Jandan accounts of 10.7 lakh women and through 108 rural cooperative banks. We also have a eShakti portal because for the microfinance, we have a digital portal. And from that, health advisories were sent and a lot of capacity building and literacy measures we had undertaken. Now, let me switch over to what we are doing for the sustainability of the financial institutions. Of course, commercial banks are not within our purview. We are the, supervisors for the rural cooperative banks and the regional rural banks. Both put together are called the rural financial institutions. And apart from being supervisors, NABARD has got a very unique role. I don't know how many organizations in the world have a parallel to this, because we have a unique function called institutional development. Now, why are we doing it? Because I need not say that more than 80% of our population is in the rural areas. And if you look at our farmers, around 85% are small and marginal farmers. What does this translate to? It translates it into a credit requirement in small doses, that is a large number of accounts with very small amounts, be it savings or lending. So now what has happened is, when you look at these two sets of institutions, the RRBs and cooperatives, they are very, very unique because, in fact, you should say that they are the cooperative banks were the first institutional attempt at financial inclusion. And this was done way back in 1904, the Indian Cooperative Societies Act. And in fact, the first cooperative society was formed in Tamil Nadu, Tirur, in Kanjivaram district. And during the British time itself, there was an attempt to meet the credit requirements of the rural poor through these cooperative banks. Then, of course, after independence and after RBI came into being, in fact, RBI had these two departments, ACD and ARDC, to exclusively attend to the agriculture and rural development sector, out of which, as I said earlier, NABARD had come up. Now, these two institutions are very critical because the commercial banks, as we call, they are commercial in the sense, we expect them to generate profits. They are, they have gone public. They are accountable in different fashions. But here, the rural banks are different because if you see, they have got a mandate of lending to the poorest of the poor. The cooperative societies formed much earlier. And then, here you have the pure societies which are non-credit. You have in every sector, dairy, consumer, marketing, Amul, Kripco. Then if you see that Legit Coupled, all of them are big societies. Okay, the work done by big societies. Those are the non-credit societies supporting their members for in whatever functional area they are in. Then you have the credit societies, which are your primary agricultural credit societies. And they are basically, out of the purview of the regulator. Basically being societies, they are registered under the State Cooperative Societies Act. And they are registered there. There are certain, their administrative matters pertain to the state government. Their board has sometimes political coloring. And if you see, so governance is a kind of issue. And then, as we famously call, dual control. Now, all of you would have heard about this because of the newly formed Ministry of Cooperation in Government of India last year. Because here what happens is, the cooperatives, why there is a dual control registered under the state government, to a certain extent, they also have non-credit functions, such as distribution of fertilizers, a lot of state government programs they implement. And then, they especially the DCCBs and the SCBs, they are also banks. DCCBs are not scheduled. State cooperative banks, 50% of them are scheduled. So they fall for the banking functions, they fall under the purview of RBI. And we are their supervisors. So because of the dual control and because of the, the initially, if you see, pre 2000, till about the late 1990s, it was both the RRBs and cooperatives had a predominantly social agenda in terms of delivering credit to the weaker sections. So it was, they would be in losses. And it was kind of, not highlighted upon, though it was a matter of concern. Like if you find in the earlier NABARD annual reports, we always used to highlight on how many are in profit, how many are in loss. And we have taken a slew of measures, which I will come to a little later, for making them sustainable. Now, the RRBs were, till the SFBs and the small finance bank came, the RRBs were the last entrant in the rural financial scenario. They were brought out, the commercial banks were there, but their orientation was towards lending to the urban areas. In fact, that was one of the reasons for nationalization of banks. It happened so that they could reach out to the nook and corners of the country. But even after nationalization, still the credit, it did not reach to the desired level. So based on the Narasimhan Committee report, in 1975, in fact, on 2nd October 1975, the regional rural banks, the first 5 started functioning. And over the period of next 5 years, 196 banks were set up. They were a kind of hybrid structure, They were to be a low-cost structure modeled along the state government lines, state government institution lines, but they were doing banking functions, and they were sponsored by Government of India with 50% share, state government with 15% share, and the sponsor banks, that is the commercial banks. In fact, there are 12 commercial banks right now. At that time, it was 28 commercial banks who had sponsored different RRBs in different regions. So now what happened, when you looked at the 1990s, you take a review. It was, we had 196 RRBs, and 1995, I remember, they were making 365 crore losses they had reported, the system as a whole. And we used to say they were reporting 1 crore loss a day. It was easier for us to remember the figure. To this day, I remember the figure. And, then the question came up. And in fact, the RRBs, which were supposed to be low-cost model, were brought at par with the commercial banks because they were doing the functions similar to commercial banks. And so the low-cost structure got broken. And then what happened? They were brought at par with them, with becoming a little higher cost structure. And then in 95, 96, once this hit this 1 crore a day figure, it drew the attention of Government of India. And then, especially because RRBs were enacted by the RRB Act was passed by the government. And there, and being the largest owner of these banks, it was government took a lot of initiative. There were several committees set up. Most of the committees have been headed by chief general managers of NABARD. And then a series of measures for their sustainability was introduced. That is, recapitalization was one. Then, freeing their operations was another. Strengthening their manpower was the third one, and enabling policy environment were the fourth ones. And all these were implemented through NABARD. The policy framework which RBI introduced was all in consultation with NABARD. Then subsequently, in 2004-5, what happened? The Rakesh Mohan Committee, not the Rakesh Mohan Committee, sorry, internal committee of RBI said that the problem with RRBs is 196 RRBs in about 35 states. And you had in UP, say, 8 RRBs, and many of the states had 4 or 5. So essentially meant smaller entities, which did not facilitate economies of scale. So a decision was taken to amalgamate them. Right now, the process of amalgamation started in 2005-6. Right now, it is stood at 43. It is 43 now. Now, why are RRBs important? RRBs are important because they have around 21,000 branches. They are present in every district. They are present. They are very close to the rural populace. They are essentially, if you see the RRBs, as per the mandate of RBI, 85% of their lending goes to the priority sector, which is mainly the agriculture and the allied activities. So they are big vehicles for, delivering credit to the rural areas. And if you see the total number of accounts, there is around 8.5 crore accounts under agri and rural, agri and allied activities, out of which 50% is with the commercial banks with their sheer size and spread. Then about 30% is with cooperative banks and about 20% is with RRBs. RRBs, their average loan size is around 80,000 rupees only. So this shows how much of smaller lending they do. So now we have taken several measures, mainly because of our institutional development role, as well as the statutory obligations which we have. Because the role of NABARD for the development of RRBs is specified in the RRB Act itself. So we are there on their board. We are to guide them throughout. We have our Bankers Institute of Rural Development, where training is being given for the cooperative banks and RRBs. Those programs which are of government related programs and of microcredit, and all these are done free of cost. And there are there are paid programs which the banks get trained there. So this is what we do as far as the RRBs are concerned. And the next thing is the cooperative banks. I will now come to cooperative banks because cooperative banks require a little more, elaboration. Now, I will talk about the rural cooperatives. It is just not the banks. Because when you look at the rural cooperatives, when you talk of cooperatives, immediately everybody will realize, PMC Bank and all that will come to your mind. But those are urban cooperative banks functioning in the urban areas. I am talking about the rural cooperative structure, which is divided into two. One structure meets the short-term requirements of the rural, of the farmers, and another you have the long-term structure. That is, the long-term structure finances, gives credit for all those projects above 18 months. That is for, say, land development, for minor irrigation, for pump sets, and even dairy, for everything. Then you have the short-term structure, which predominantly, was focusing on the croplands. But gradually what happened, the long-term structure became very, very weak because the long-term structure had no avenue for resource mobilization. They were only dependent on our refinance and on the state government funds. So this, with the increasing, poor quality of assets, because all banks which avail refinance from NABARD are also subject to certain norms. And because of that, what has happened now, they have become weak in many states, though they are still functional. And in some states, they are doing very good work. Now, the second set of institutions which we will be focusing upon is the short-term cooperative credit structure, which has got 3 layers. Okay, you have the primary agricultural societies, which are the base level societies. Every 6 villages has a pact. And these pacts, the farmers are members here. The farmers are members here and they can deposit their money and then they are given credit. And they are given credit now. And here what happens is, this being the only source for the pacts, they are dependent on their next tier for the resources. That is, the pacts are affiliated to the district central cooperative banks at the district level. What do the district central cooperatives do? They are the middle layer. At the top, you have the state cooperative banks. Now, the state cooperative banks takes refinance from NABARD for all these agricultural operations. What I said, 50,000 crores spread across the country. Then that is passed on to the DCCBs, who in turn pass it on to the pacts. This happens in about 18 states, whereas in the remaining states, the SCBs are directly funding. It is a two-tier structure where they are directly funding the pacts. Now, the pacts are typically very, very small entities. They are not banking entities. So they are out of the payment infrastructure. They are affiliated to the CCBs, who are banks, who are into the payment infrastructure. And what the DCCBs do is, they do a lot of handholding of these pacts. Now, the pacts, as I said earlier, do a lot of programs for implementing the state government schemes, like procurement of grains in some of the states they do. Fertilizer supply is through pacts. That is what makes them very, very critical in the rural areas, because there are some fertilizers which are available. They are the only outlets which will give them. Then they do soil testing. They do now, NABARD has got a scheme for making them multipurpose societies. So they are, we would like them to be one-stop shop in the rural areas. There are many pacts, especially in South, who are even having shops. And if you see across the country, you have 95,000 pacts, and the strongest are in Kerala. If you see the Kerala pacts, it is an unbelievable story, Like in one of the pacts society whom I had invited for one of my conferences, there, they have only 2,500 people in their village, but they don't go to anybody else. They are the pacts is the only entity which is meeting all their services. They are fully into the digital mode. Of course, being non-banking entities, they are affiliated to any one of the private sector banks and using their payment infrastructure for this. And there, I was told was that even if a person goes by auto, the auto fare is transferred like how we do right now. This has happened about 8 to 10 years back in Kerala. They are very strong there. Almost 50% of the deposits collected by pacts are collected in Kerala. So now these pacts, what is their typical problem? Because very small entities, they did not have standardized book of accounts. They were audited by the state government department. Audit was in arrears. Then, typically governance, because all of them are within the same area, very poor level of knowledge and awareness. So then, if you see even now, only about 50 to 60% of the pacts are fully viable. Now, this is as far as the pacts are concerned. Now, they are affiliated to the cooperative banks. We had supported the cooperative banks for supporting the pacts. Like we had the pacts development cell in cooperatives. Now, the CCBs, which we call the district central cooperative banks, they are banks. They do lending primarily to pacts. They are refinancing the pacts, but they also do some direct lending. Of course, it is subject to state government regulations. Some of the state governments have said you do only non-agri because the pacts are doing agri activities. So then, the CCBs are now subject to all the regulatory requirements. Capital adequacy norms are applicable. Risk management systems are prescribed. All these are done by NABARD with the approval of RBI. We supervise the DCCBs. Those CCBs which are having 6,000 crore business and above, we do annual inspection. The remaining we do every alternate years. We are, they are subject to exposure norms, so that if you see, except the crop loans, if they are going to take huge exposure to sugar or any other sector, that we record it and then we try to take necessary steps. RBI, the inspection reports are sent to RBI, and so we are in tandem with RBI, supervising and ensuring that they follow banking principles. Now, next to the state cooperative bank, they are state level entities. They are the balancing centers of finance, and they are 34 in number. And the SCBs in the recent past have metamorphosed, because what they have done is they have adopted technology. CCBs have not have been slow in adopting technology. In fact, we helped them to get into CBS. That was in 2014. We had supported 200 banks by identifying 2 vendors. They could opt for either of the vendors. There was some funding support we gave, and also for CBS Plus activities, we are still supporting them. The SCBs on their own have got into technology. And in fact, if you see, many of the urban cooperative banks as well as the DCCBs are their affiliates for using the platforms, the other enabled systems and all this. So here what happens is, if you now see both the RRBs and cooperatives, what are their biggest problems? Because typically rural lending is very costly, because unlike the commercial banks, which have bigger accounts, huge sized accounts, and which obviously bring in a higher stream of cash flow, here you are dealing with large number of small accounts. Physical presence is necessary. RRBs, typically, they also employ VCs. So here, what happens is this all adds to the cost. And the branch banking is very, very expensive. They are facing tremendous pressure through competition. Their margins are very squeezed. They are expected to adhere to the regulatory requirements, capital requirement. Whereas now the commercial banks can go and tap the public, for equity. They don't have any source for equity. Only government recapitalization is the only source. And HR, because believe it or not, only very recently you are having people who are opting for the RRB services. Even the employment in RRBs or in cooperative banks, the frontline, you are not going to get business management students there. They're all, busy with the public sector banks and private sector banks. And so typically there is HR is an issue. And so it is here for both the set of institutions, we give tremendous amount of capacity building support. For the rural cooperative banks, they have their training institutes, which are funded by us. We have a cooperative development fund, which is a fund established in NABARD out of our profits. And so far, more annually, I think we give about 10 crores or so for meeting the capacity building requirements. We have exclusive wing looking after them in our Bankers Institute of Rural Development, Lucknow. And now with all these measures, what has been the benefit? That we find that there is a better compliance to the regulatory requirements, because the moment, in fact, the review of whatever we do is done with RBI on a quarterly basis. We have a RBI coordination, NABARD coordination committee, where both policy level and very tricky operational issues are, discussed, and we arrive at a common framework to implement them. So largely, if you see, they have now put in place some risk management measures, though not to the extent of commercial banks, meeting the regulatory requirements, improving asset quality. This is something very, very remarkable which has happened. And right now, with all the digital pressures which they are facing, they have also gone digital. And along with going digital comes in the biggest issue which all the banks are facing, which is cybersecurity. NABARD has a seaside cell. I myself have headed the seaside cell for a year. And we are monitoring these banks Actually, Government of India is doing wonderful service. RBI is doing wonderful service here, though this will not be known to many. The Government of India, they have an exclusive NCERT, which does a minute-to-minute monitoring of all the transactions. Transactions, matlab not the debit and credit, but the inflow of the data, outflow of data from where it comes and where it doesn't come. We immediately get an alert saying that these are the banks, your banks, in which there has been an attempt to breach, and you immediately want them to put in adequate systems. Last 1 year, we are doing that also. So this, if you see here, the sustainability of these rural financial institutions is a work in progress. That is the reason it is one of our core mandate. We have an exclusive institutional development department which supervises all this, and they take inputs from our Department of Supervision, which will immediately raise the warning bells if something is going amiss. So this is what we do for the rural financial institutions. Now I come to my second part of the talk, which is on the microfinance institution. It was very interesting to listen to Professor Hamid, because he was talking about the MFIs largely, so many of the issues he has covered. But before even talking about the MFIs, let me talk first about what NABARD has done in the sector. Because I am heading the Microcredit Innovations Department of NABARD. So I think, I should take you through very, very briefly through what we are doing. Now, if you look at the SAGs, the self-help groups, I think all of you would know what it is about. I will now speak with a lot of pride, because, the SAGs was something. If you talk about SAGs anywhere, you go to the net also in search, NABARD's name will come up first. This was out of our pilot project. Of course, Muhammad Yunus was already there in Bangladesh. We went and studied. And then, we did the first pilot project here in 1992. Very small project. And, the project was very successful. Why did we do it? First, we have to look at the whys. Because even before the term financial inclusion and the financial exclusion, which came much later with the Rangarajan Committee report in 2000, even much earlier, we recognized that there was a large chunk of population which was being left out of the banking fold. There were people in the rural areas who would not enter a bank. So that is when we felt that we should do something and to increase the banking practice, to increase the savings culture, and to generate local level, self-employment, employment. Now, in 1992, when we did, it was a very small experiment. And when we saw the success of it, what was the target we had in 93, 94? 500 groups. 500 groups. And then we exceeded the target, it went to 800 or something like that. Then with that, in 95, we said we will do 10,000 groups. But in the meantime, it attracted the attention of Government of India. Government of India, the then Finance Minister Yashwant Sinha simply said 1 million groups. Like, we were startled. But then, it became possible. He said 1 million groups in a period of 5 years. It was accomplished in 3 years. This is typically, a very small 15 to 20 members, or now even 10 to 20. The basic thing about a self-help group is the savings habit they inculcate. And when we saw in 1992, it was 2 rupees a week. Okay, as small as that. Now, of course, it is much different. So here what happens is they do internal savings, they do the internal books of accounts, and after 6 months, and out of the internal savings, lending is done. And after 6 months of this internal savings and lending and the maturing and the stabilization of the group, after 6 months, they are linked to the banks. The banks typically touch them only after 6 months. And then, loan is given, and the loan is in a escalating fashion. And the average loan which SHG received in 1995 was 25,000. Today it is 2 lakhs. I'm not very happy about it, because 2 lakhs is still for 10 members. If I literally do a per head calculation, it is 20,000. With 20,000, you can't even set up a chai shop. It is very, very difficult. But then at that particular point of time, this took the entire, rural area, literally, I should say, by a storm. Very soon, within 10 years, it was spread everywhere. In fact, looking at the success of the program, Government of India first came out with that Swarna Jayanti Swarajgar Yojana, the SGSY. And in fact, the review of that was done by BIRD, the Bankers Institute of Rural Development. And the team which headed it was Dr. Jia Chintala, our chairman NABARD now. So we have done a complete review. And then subsequently now what has happened? After that, I will just take about 5 minutes of your time. Then you have the National Rural Livelihood Mission, okay, the NRLM. So now put together, this has become a huge sector. There are 1.12 lakh crore SAGs now, but there is a shortfall of bank linkage. There are a lot of issues here, which requires a separate dealing by itself. If people are interested, you can go to our website. We bring out an annual publication, The Status of Microfinance in India. It is an annual publication and uploaded in NABARD website, which will give you the entire data and write-up on the SAGs. And it is a researcher's delight. And then very briefly, I will touch MFIs because my earlier speaker touched a lot of issues. See, typically MFIs have this issue because, their resources are an issue, but of course for the smaller MFIs, the bigger MFIs are now comfortable. Initially, yes, they were very dependent on the donors, but then now if you see, there are a lot of success stories because he was saying why India is doing better, because there are two self-regulating entities. You have Sadhan, I'm on the board of Sadhan, and then you also have the MFIN, who are self-regulating entities. The MFIs are members there and their activities are reported and streamlined through them. And they report to NABARD and RBI also. Not exactly report to NABARD, but we are taken into confidence. And then, these MFIs, the success story is Bandhan Bank, which was a MFI, is a universal bank now. Then the SFBs were all earlier MFIs. Okay. The MFIs had typically, liquidity issue during the crisis, and RBI and NABARD, through NABARD, we have given them the support for, liquidity support. SIDBI has also supported them. And see, governance, whether it is MFI or the rural sector, governance is an issue. Governance is something which has to be looked into. For paucity of time, I'm going to conclude my speech now, though I was not able to do justice to the microfinance portion of it. Right now, what I would like to say is, finally, microfinance institution being the third operating wing in the financial services sector, we now cannot imagine a life without these people. They have to be there. They are necessity. But as highlighted by Dr. Hamid, it requires a strong in terms of financial health, systems and governance. And they require sustained handholding support, and so that the inroads made so far are irreversible. Let me once again thank the organizers for inviting me for this speech. And I wish you a productive set of discussions for the rest of the conference. Thank you so much, sir. Thank you.
Thank you so much, ma'am, for your words of wisdom. Thank you for bringing to light the journey of microfinancing, its inception and growth in the country, and also highlighting the challenges that these institutions face. We also like to thank you to bring forward the contributions and work done by NABARD and RBI in the rural areas. We're really humbled by your presence, and I'm sure the attendees have learned a lot with the insights from your professional career. I would now like to invite Associate Professor of the Department of Finance and Law, Dr. Raghukumari Suresh, to propose the vote of thanks.
Can I say something?
Please, madam. Please go ahead.
Yeah. So I'm the Monica Khanna. I'm the director of this institute. Madam, I was really listening to your speech with great interest. I just wanted to say one thing, that I've grown up with these words, My father was in RBI, and in 73, he got transferred to the College of Agricultural Banking in Pune. So words like rural regional banks was from 73 to 83, we were in Pune. And words like rural regional banks, microfinance, I've grown up with these words actually. So it was like a sort of a bringing back of a memory of the old days. So I'm really happy to know the type of work that NABARD is doing. I think NABARD was made out of RBI, if I'm not mistaken, the Agricultural Credit Department, ACD.
Yeah, ACD and ARDC.
ARDC. I'm very familiar with all of this, having grown up as a child with all of these things. These words are all with me.
Thank
I
you.
really appreciate the work that you are doing now.
Thank you. Thank you.
Even I am also reminded of my banking days. I was working with a public sector bank. So rural lending, rural credit, all are very close to my heart. Madam, we will invite you for detailed discussion because
I think that's
we are teaching financial inclusion as a course to our finance students.
Oh,
that's
So I will definitely invite you for a guest lecture kind of, without any restriction of time.
Oh,
So
I'll be very happy.
Because I could see you are living rural credit.
Really rural credit. And in fact, the Vaikund Mehta National Institute of Cooperative Management, that was inside the CAB campus only in Pune, and it was on the ground floor and CAB was on the first floor, And later on, it became a full-fledged campus near the Pune University. So I've seen that whole thing, as a child, I've seen everything.
They have Center of Excellence in Financial Inclusion at College of Agriculture Banking here.
We have a Center of Excellence in Cooperatives in Lucknow.
Okay, so rural regional banks and all, I always remember my father talking about all these things, Yeah, in fact, that movie Manthan, I must tell you, I must have seen it at least 50 times. Because every time a batch of trainees would come from RRB, they were shown Manthan, and then we as children would go and see Manthan, So I've seen Manthan many times. Okay, nice. Really nice to listen to you, and thanks for coming here.
Thank you.
Thank you. Please proceed.
Madam Raghu Kumari, you can proceed, and we will start the next session at 2 o'clock. Make the announcement subsequently like that. Madam, please, Raghu Kumari, madam, please go ahead.
Yes, sir. Thank you. Good afternoon, everyone. I feel honored and privileged to get the opportunity to propose a vote of thanks on this special occasion. First of all, I would like to thank all the honorable delegates who blessed us with their presence, and indeed, it was so insightful. On behalf of the Sifico 2022 Organizing Committee, I would like to convey my heartfelt thanks to all the supporting authorities. First of all, our Honorable Vice Chancellor, Dr. Rajashekaran Pillai, our Director, Dr. Monica Khanna, our ACP and Dean, Dr. Pankaj Trivedi, for the constant support and guidance. I would like to convey my heartfelt thanks to all the teaching and non-teaching staff, and especially IT department for giving us all the necessary permissions and support to arrange the event. We have been fortunate enough to be supported by a team of enthusiastic students committee, and that is our Fin Street team. Thank you very much, Fin Street, for your seamless coordination and execution of the event. Our theme for this year is Sustainability in Financial Markets and Institutions. On this occasion, I would like to request everyone that let us contribute to the sustainability in all the spheres of life, and let us make the lives better. Thank you very much for one and all who are present in this occasion.